All right, welcome to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm joined here, as always, with Renji Matthew. And today, on today's podcast, we're going to be talking about the surprisingly low forecasted returns for the S&P 500. And Renji, why don't you get us started off? And what is Goldman Sachs predicting the market to do here over the next 10 or so years?
Well, they're predicting that the total returns will be around 3% or less over the next couple of years. I think they're thinking it's going to underperform bonds, and it probably does have to do with how the market's been doing the last 2 years. Has been better, since COVID and everything. And we know, every time the market goes one way for too long, it has to go the other way, right? Eventually. But yeah, that's what the predictions are. What are your thoughts on that?
Yeah, so to me, obviously, that's really low, and low compared to what? But the S&P 500 over, the last 30 plus years, its real return, which is adjusted for inflation, has averaged about 7%. And, with that, its actual average rate of return over the last 10 years has been closer to about 12 or 13%, while over the course of its history has averaged about 11%. So a lot of numbers, a lot of statistics there, right? What does that all mean? Long story short, what they're predicting, what I see, the only way it could really, only average about 3% over the next 10 years, which is a long time span, there would have to be a large market crash in there. And we've talked about it. There's been a lot of signs that have kind of pointed to it for the last few years, and we haven't hit that yet. But every business cycle, every market cycle does have to have a correction to get back to the points of steady long-term growth, right?
Yep.
So Goldman's bearish outlook actually comes from the S&P 500 as it's going into 2025 on an upward trajectory. It's been doing really, really well. And a couple of things that they're actually stating and pointing out is that they're warning that the recent returns have been driven by a lot of tech stocks, which are referred to as the Magnificent Seven. That includes NVIDIA and an Alphabet and Facebook and Amazon. Some of the largest companies have really been driving a lot of the growth over the last few years. And with that, they go on to say that it's difficult for any firm to sustain high levels of growth and profit margins over extended periods of time. So they're just saying that over the next 10 years, it might not be sustainable. Now, Goldman is kind of actually out on their own over here with this prediction, as JP Morgan came in recently saying that they're predicting about a 6% return, as well as other, pension funds predicting maybe 6 to 7% return. So Goldman Sachs is kind of going out on a limb here with predictions that are just not common from other places in the market. But with that, Renji, how do you feel about the market? And once again, guys, this isn't financial advice. This is just coming from two dummies that are educating on information that we see in the market, information we're talking, with our clients about. And this is not intended to be financial advice, simply just financial education. So with that, Renji, what do you see? How do you feel in regards to the differing reports and, what you think the next 10 years or so could look like?
I do agree with the fact that, whatever goes up must come down, right? And same vice versa. Whatever is going down for too long, it has to come up too, especially when it pertains to the market. And the last 2 years have been up. So it's funny because all these predictors, that's what it is. It's just predictions of what they think it's going to do. I think, was it last year or year before? I think it was last year. Bank of America predicted the market will be negative 18, and it was up 20 something, right? So these are all experts trying to predict what they think the market's going to do. And exactly what it is predictions. So they are not fortune tellers. They can't tell you what the market's actually going to do. They can do their best assumption. So with that being said, we always talk about how to protect your money, especially when you get closer to retirement. When you're young, no worries, take the risk, and if you're older, especially when you're getting in the late 50s or older, you want to think about protecting at least part of that, a percentage of that money that you've been working so hard to put aside for retirement, because you don't want to depend on the market completely. Of like, let's say you're about to retire next year and the market crashes. Now that money you were depending on to retire on is a lot less than what it was, what you thought it would be, right? So you always want to diversify in that sense to protect yourself, right? The reason people say diversify, it's not only for the growth in different sectors, it's mostly, I think, is to protect yourself. Because what do they say? Don't put all your eggs in one basket. The reason is you don't want that basket falling out from under you, right?
Yep.
Because if you did that and you're depending too much on that one basket, you never know what's going to happen. So those are some of the thoughts that went through my head. And then we do talk about passive income a lot, which is another way to set up yourself for financial future, to have a more predictable uh, outcome, right? So what are your thoughts on that, Kyle?
Yeah. So correct. Risk isn't necessarily a bad thing, just depending on maybe how close you are to retirement and what your risk tolerance is. And, if you're one that doesn't like taking a lot of risks, you need to analyze then where you have your money. I talk to people all the time that have no idea what their funds are in, what they're invested in, and they have no idea how much risk they may even be exposing themselves to. And seeing reports and things like this come out, I mean, that should be scary if you don't know what your money is in and what you're invested in. Like we said, especially as you do get closer and closer to retirement. And like always, we've said it before, and I'm sure we'll always say it again, time in the market is always better than trying to time the market. So like it says, they're expecting JP Morgan's expecting 6% returns, but that's over a 10-year time horizon, right? Over every 10-year time horizon, dating back to whenever the stock market was created, the market always, I should always trend in an upward direction, right? Over the course of time. It's when people lose a lot of money when they're trying to time the market and they're buying Bitcoin, they're buying stocks now because they're doing really well, when in fact they're buying at the total wrong time because they're buying at the market highs. They always talk about you want to buy low, sell high. The thing is, that's way harder to actually implement than it sounds. It sounds easy, but in fact, most people actually buy when the market's high because now they're hearing their friends and their family talking about Bitcoin and cryptocurrencies. And they're hearing their friends and their family now talk about NVIDIA and Apple stock and Amazon stock and Tesla because, yeah, it's doing well right now, right? But what you miss out on is the 50% rates of returns it's had over the last 12 months. Like, no, you should have bought it 12 months ago. I looked
Yeah.
at NVIDIA just yesterday. Over the course of this year, I think it's up 138%. Time to buy NVIDIA might not be right now. It could be. I don't know. Your guess is as good as mine. But I can tell you what, the time to buy it was 12 months ago, right? So just all things to keep in mind when it comes to money, when it comes to putting your money in the market, whether this is your retirement funds or your 401ks. And once again, guys, I don't think we've really given any financial advice, but this is simply for educational purposes, And this is a lot about why we talk about getting into assets like real estate, because real estate over time keeps up with what the market's doing regardless. And if you have cash flow that is positive, you're always earning a return on your investment, So just some food for thought there. And with that, Renji, anything else that you want to say to wrap up our show for today then?
Yeah, you mentioned, if you get in at the wrong time. The funny thing is, most of the time when we hear about something that's making a lot of money for them, where you see these ads on social media and stuff, usually by that time it's already doing too well. Like where when you get in, you're saturated or something like that, right?
Yeah.
Like you said, Nvidia was doing so much better, and 12 months ago was probably the best time to get in. And exactly like Kyle said, we can't predict. It might do another 100, go up another 100% next year, or it might go the other way. Like we saw, I think one of the stats said, no company can keep up profits for too long at that same rate. So it's going to come down at some point. So that's why market always goes up and down, and hence why we also talk about diversifying in different stocks or putting some of your money into assets that produce cash flow, because again, diversifying is always good. And you have tax benefits with especially assets like real estate that will protect you and help you keep more of your money in the long term. Because especially with real estate or anything that brings you passive income, no matter what the market's doing, if it's up or down, if the value of the house is up or down, you still have that cash flow that's coming in. So even if the market's down, people still need places to live, right? And you're still going to get that positive cash flow coming in if you have that set up already. So this is more so reasons why you want to look at what all is out there. And again, like Kyle said, this is not financial advice. This is educational. If you guys want to talk about any of those topics, you can always look out there, see what else is out there. And like Kyle said, we have our school community that you can always go and check it out, especially now that it's free right now. It might not be for too long, but it's always some an extra resource that you can always check out on.
Absolutely. And with that, if you guys do want to check out the school community, we will have that linked below. If you want to build wealth, if you want to reach financial freedom, that is exactly what we are helping you guys on the path to doing in the school community. We've got 40 plus members in there, and we are going to start doing some bi-weekly workshops in there, helping you guys with different aspects of building wealth as it entails. So thank you guys so much for hanging out with us and watching another episode of the Wealth Building for Dummies podcast. And we'll see you guys on the next one. Take care.